In the U.S., it's a little bit more, total returns are driven a little bit more by income than by growth. We're just at the point in the cycle right now where in the commercial sectors, rent growth is starting to pick up. In Europe, in the short run, most of that total return is coming through income. We don't expect a considerable amount of rent growth, with the exception of sort of the Nordics and some other core markets. But as we move out past the first few years of this forecast period, we see higher growth there. Now we're looking at a point where some of those risk-free rates or sovereign yields are now in excess of the initial yield. So maybe that says that real estate is the new sovereign bond. We'll see.
Yeah.
I wanted to also just highlight a couple things in terms of differences around the globe.
We talk about safe German yield, right? But when you look at the total return picture for Germany, they're a bit of an outlier at the bottom left of your graph.
And I think part of that is possibly due to the early part of this period when the effects of reunification was still impacting the real estate property markets. My guess is now that obviously Germany is very strong. It's significant levels of productivity, low unemployment rates relative to other parts of Europe. I would expect, and there seems to be enough capital looking for German assets today, it wouldn't surprise me to sort of see some of these total returns increase. It is really striking to see that perhaps one of the reasons why Europe may be tackling this today is just because of the older age of the population and the need to sort of address some of the debt issues today. Asia went through its issues back in the late 90s. The debt balances have gotten under control there. And as a result, GDP is expected to grow better in some of those markets, notwithstanding obviously what's happening in China. So I could see with what's happening in Europe today that there could be a very bright future for Europe. It's also interesting in aggregate when I think sometimes people overlook the amount of debt outstanding. In Europe, it's only, the amount of debt outstanding is only 70% of the amount outstanding in the U.S. So the debt levels are lower. It is striking to see some of the markets like Spain, and these are 2010 figures, so they're probably slightly higher today. But certainly in certain markets that we hear about in the news and so on, those debt to GDP levels are certainly lower than they are in other parts of the globe. So I think the U.S. has a bit of time on its side to address it. Certainly, what came out of the congressional agreements last year is that America's or U.S.'s own austerity programs are likely to begin in 2013. I'm a bit optimistic about Europe, but then again, I'm a real estate person. I think we're optimistic by nature. But nevertheless, to me, it doesn't seem as bad as what some of the headlines might suggest. And certainly what the ECB has done is a positive move. These are just some of our forecasts. I've talked a little bit about GDP, but in the interest of time, let me just move on a little bit. Obviously volatility has been, and risk aversion has been prevalent over the last few years. I think what has happened, with what in the U.S. in terms of growth picking up a little bit more, certainly the recent moves by the ECB and some of the resolution that seems to be happening with the restructuring of the Greek debt. And the lower left-hand, or in the lower chart, volatility has been reduced considerably. And at the same time, equity prices are starting to rise. Obviously, that's a positive signal for real estate markets in terms of improving consumer and business confidence. And to the extent these trends can continue, it should lead to a pretty healthy 2013. As the economies around the globe begin to improve over the next 2, 3, 4 years, obviously we do see interest rates increasing, to the extent of maybe 100 basis points, depending upon which country. With where initial yields are today, that's not a significant enough move to really derail the outlook for capital values. Obviously, with spreads being as wide as they are today, there's clearly plenty of cushion there for interest rates to rise without it really impairing values at reversion.
We are trying to learn from this crisis we went through. And maybe one of the big lessons that we learn is a certain limitation to the financial contracts we get into with one another. I think we have been very focused and done very well in designing contracts that provide the right incentives, when returns on assets are positive and when prices keep going up. But we certainly realized with the crisis that the contracts we were writing with one another maybe didn't really take care of all the potential outcomes when things go bad. And we find ourselves in court and in litigations trying to figure out what it is that we really agreed to do and how we're going to move forward. And it's going to be interesting to see how this pans out in terms of the competition within that industry that serves us as intermediary between those of us who want to save and those of us who want to use real estate. And so if we're trying to reinvent ourselves through different ways of interacting with one another, what type of investments are people pursuing? And really the big words everybody talks about is core or core plus. But I think a bit core means more this year than it did last year. We hear about maybe what I would call core plus periphery. So in moving from central London to the sub-centers of London, or moving from central London to Birmingham or Manchester, or within the US, rather than investing only in New York, looking at Boston and Chicago and Los Angeles and Houston. So it's core and the periphery. We've talked about how through this crisis, real estate has survived and done well as an asset class. And this year I wonder whether we got that right when we used to say real estate is an asset class. I think core has really become an asset class in the same way stocks and bonds are an asset class for the big portfolio investors. Why? Because in today's environment, yields are terrible everywhere. If you're chasing yield, you're going to go to real estate.
I wasn't here last year. Was the response here, do you think, more about the view that core was getting overpriced and that's why there was such a high response? And today, is there a view that opportunistic investments may be attractive and that's why we got a yes?
I think it's a good question. I think, unfortunately, whenever we ask this question, we cannot ask people, by the way, how did you hear the word core? Right? And I think maybe the reason it's the same is because from last year to this year, that core definition evolved. And it's less core this year than last year. It's just whatever you need to define it so that it's 70% yes. And I wonder. We thought the comparison was striking. Yeah. We are living within this context of the euro crisis. And then some people are really worried about it and it's making them more cautious. They say, no, not at all. I mean, actually it creates opportunities for us to redeploy our capital and shift capital. So that there's the same theme of very split point of views across the community, sometimes split within the same person, actually. We had people asking whether they could answer both yes and no on these questions. For the most part, people enjoy coming to MIPIM, and they live happier than they got here. And it was a rainy weather on the first day, and look at today. It's a beautiful day. No reason to not be more optimistic. Now, I mean, this is cheap talk, right? Are you more optimistic? Yeah. I mean, this is real estate after all. We're a bunch of smiling people. So we did ask a little bit further, what is your perspective on your real estate market compared to same time last year? And it's good to see it is consistent for the most part, except for the 15% that are less optimistic. Most people feel the same, or half of them feel even more optimistic this year. Was
the survey taken when it was raining on Tuesday?
No, it was taken yesterday. It was taken yesterday. No, we don't take surveys on rainy days. Okay. So no, it was taken yesterday afternoon. And really, so we are a business school, and we are here with our students, and this again could be cheap talk about your perspective. And really, there's one thing we really care about, and I think you also share that same concern, is if you're optimistic, are you actually going to hire, right? And so that's the last question we ask, is your optimism going to translate into actual actions within your company? And so are you planning to hire this year? And it's good news. It's about 2/3 of the people are telling us that yes. They are sufficiently optimistic that they might bring more staff within their enterprise. So just in conclusion, if you haven't had time to see it yet, I want to point out to two headlines this morning on the front page of the Financial Times. Bondholders back Greek bailout. We have had so many positive headlines about Greece for the past few months. I don't know if that's going to be one more spike on this volatility index. Today is down, and let's see what tomorrow brings. Maybe it's the last spike. I don't know. But then, we're talking about transparency and control. And I really liked on the header of the FT, there was this other headline about too much information, are regulators overwhelmed? And I wonder if tomorrow the headline will be the companion headline, too much information, are investors overwhelmed.
Mhm.
I don't know where we stand. We'll see what next year's MIPIM bring.